all of you, and good morning, good afternoon, and good evening to those that are following us virtually. My name is Masamba Choi, and I'm leading the UN Climate Change Global Innovation Hub, and I'm very, very pleased to welcome you to this very important session on finance. So on Monday, we had a focus on system change. Yesterday, our focus was on cities, because cities are a key component if we want to address the challenge of climate and sustainability. And today, we will focus on another very important topic, which is finance, because without finance, we will not be able to achieve neither the SDGs or the climate goal. So, Sharm, welcome to the Global Innovation Hub Pavilion. Now I will hand over to our Master of Ceremony, Tal, who will introduce the different speakers.
Good morning. You know, Jonas Salk, who used to research the polio, was quoted by saying that the reward that for a work well done is the opportunity to do some more work. And having you all together here I ended up also the MC for this morning, so excuse me, I couldn't sleep like the last 2 days. I'm working hard on breathing, even though I've been doing it for 40 years now. And I'm really thankful and grateful for the opportunity to work with the Masamba, Carlos, Sylvia, and this amazing team. This event we are part of during the Financial Day. It's the Financial Day theme in COP27, was created 6 months ago. So we've worked on it. Some of you have been working on it forever, the front row here. You know, the brains and power we have in this room, just for the people we have gathered here, can actually tackle the world's financial issues pretty good. So this morning, the conversation we've had with Masamba back in April this year, and the MENA, Middle East and North Africa Climate Week, we took on with working with the Masamba and his team to accelerate and generate a stronger conversation to create financial solutions to the largest problems we're out to tackle. The people in the front row, and those of you who are joining us from around the world, we are broadcasting live, so some people are now, it's morning, evening, wherever you are. This is not the end. Today is the beginning. It's the beginning because what we have here is a brain power team, committed team, action-oriented team from the World Academy of Art and Science, NSDSN, and all the great partners coming together on behalf of what every now is realizing, and I've heard Professor Kahane, who was my partner for a long time, to tackle the financial challenges. So we called this gathering today, kind of wanted to be the first global financial summit in COPs. This event we're starting today is aiming to that every year during COP, when we have a day on financials, some great people like the brain powers, who I'm going to introduce in a minute, because those who I know are in the front, and some of you we haven't met yet, to generate a conversation that we are not going to be standing in front of the kids and saying, unfortunately, we didn't manage the big money. So we are here for the big game. I'm going to really quickly run through the event with very tight schedule, and we intend to keep on it. So I'm going to now move to read a couple of the notes. For those of you who don't know me, my name is Tal Ronen. I'm the president, the co-founder of YKCenter, a company focused on accelerating the SDGs. I remember when I met Simon Zadek here, Professor Zadek, when he was in the UN advising the Secretary General in the first meeting of UAGA when we met on the floor. And it got clear to us that we need to start working on the big issues of financial solutions. And our company, YKCenter, we've worked on this event, as I said, for the last 6 months, and are excited to begin the conversation with you. And I'll talk to you about the rest of the day. We have a couple of events this delegation is going to participate with. We have some unstoppable friends that have come from around the world to join us here. Some of them are now still working with Moses. I realized yesterday why it took us 40 years in the desert. After I've been lost here for 2 days trying to find the Global Innovation Hub, and I'm really good at navigating. I'm known for a good navigator. I figure out that's what happened to Moses. He had a very bad navigation systems. That's why he did it for 40 years. You know, it's 10 hours from here to Israel. So there's some bad maps going on. And hopefully we will be able to get out of Egypt this time. You know, coming in is great, but leaving, it's a whole different story. Unfortunately, us Israelis, you know, we've been saying it was much easier to get the Israelis out of Egypt, but it was much difficult to get Egypt out of the Israeli. We're still working on it. And today we are initiating a new event, a Global Financial Solutions Summit. Our intention is that we will present every COP, as I said, going forward, solutions. So we are not going to hear, we did not have great solutions. I've got tired of hearing from pension funds, reinsurance, and all these great giants who are telling us they don't have vehicles, instruments, and so to speak, that some of what we're talking about to move the money to where it needs to go. And we're not talking about billions. Simon Zadek, when I met him on the stage, I remember when he says, I know who you are. You're the billion to trillion guy. Because we were running a campaign with them at the time of how to move the investment in the world from billions to trillions. Now everybody understands it's trillions, so we don't have to discuss it anymore. Everybody knows, and I've heard Al Gore last night, or the Egypt president, saying that we need now some estimated $4 trillion. You guys know better, 4, 5, I've heard, to cover the debts between the SDGs commitments and the ability to deliver and walk the talk. So we've gathered fantastic group of people here. We have a delegation. I call them the Galacticos, you know, like the Real Madrid players. We have great players here, and we intend to use you, download your brain power to a cohesive model that Masamba and his team can delegate it. You were all recorded, and everything that will be said today will be generated for new generation. Hopefully, some kid somewhere who's going to end up being like yourself in the Club of Rome or in some World Academy of Art and Science. So meet one of you, say, I heard this conversation, and I'm really excited about doing something to tackle this issue financially. Dr. Masamba, my friend, is the project executive of the UN Global, who is doing an outstanding job leading the Global Innovation Hub. It's a privilege working with you, and I look forward for work future-wise. Miss Rosie Hampson is going to join us. I hope I pronounce her name. She's from the distance. Rosie is now, I think, located in New York as we speak. Hopefully she'll be with us via the satellite or the web. And she is the Executive Director of Digital Assets at Goldman Sachs. Then we have Professor Yehuda Kahane, my partner, Chairman and Co-Founder of YKCenter. He's the hero of the day. He's the hero of my life. Hi, Vince. You made it. Fantastic. The Americans are here. That's great. And Professor Kahane suffered a severe stroke 3 years ago. So for a brilliant guy who speaks globally to non-able to say anything and completely deleted his ability to speak, however, today, after 3 years of attempts and hours and days of working out vowels in Hebrew, and after a year and a half in which he was able to learn Hebrew, the last half a year he's trying to regain in English, and today he's going to say 100 words in English, which is probably as hard as financing the SDGs. Maybe harder. So his ability, so when you meet Professor Kahane, distinguished guest, and one of the people from the World Academy of Art and Science, please note, he's not dumb, he's very smart, he just cannot speak. He's an amazing brain, and his ability to listen is substantial. So we will introduce you, and we ended up that Or Katzman, a young fellow somewhere here. Come on over. Yes, it's a place for you. So we have Professor Kahane, who's Or Katzman from SDG Israel, a co-founder, and VP is Internal Affairs in YKCenter, situated in New York. We call him Or Lagoyim, we just see Or going out. We send him out to be out there in New York, being a light to thy nation with the messaging of what we are doing in Israel. And SDG Israel and his team have done a tremendous work that brought us here. We also are going to have, so Kahane is going to be with us for a couple of minutes. We're going to show a short video that we luckily arranged after he suffered a stroke. Then I'll find out where I am. As I said, he relearned how to speak and will share in few words. After those words, we will show a video laying his idea out, articulated by Or Katzman, who I think as well. Then we will move to a very distinguished conversations with some of our guests here on the panel. We will present also Mr. Ketan Patel, the chairman, who's here, Force of Good, will be with us. Dr. Stefan, let me see if I can do it. Browne. Just forget it, huh? Okay. We got to work on your last name. We got to find something friendly. Browne, right? Something. No offense, but just I can say that. And then we also have some good news. Is we have Phoebe from World Academy of Art and Science. We have Moshe Bareket. Moshe is here. Is the let me read what it says, Moshe, so I get it right. I lost you. Oh, yeah, here. Who has just completed, Moshe has just completed his role, very important role, as the Director General of the Israeli Capital Market Insurance and Savings Authority. He's here with us today. Moshe will serve as Yehuda's voice. His own voice. Co-author. So that's true. Actually, like in the Bible, Moses had to need Aaron, so we needed Moses and Aaron to do this. They co-authored the presentation we're going to see today. Guys, excuse me, it's not arrogance, it's ignorance, okay? I'm just a little moved and I'm getting myself together. So Moshe has been working with Yehuda for the last 1 year, 2 years, a year and a half, 3 years? 3 years and sharing the model they'll show you today that is fantastic. It's probably the first project model that was actually tested in a real life. It's the basis of the model the Israeli was financed by initially, if I can say it right? But you'll clarify that. You guys know what you're going to be saying. Then we will have, I said, Professor Phoebe Condorori from the SDSN moderating in the panel, and Jeffrey Sachs will join us as well for closing remarks. At the end of the panel, some housekeeping. We will hear some questions, and there will be open Q&A. After this event, we invite you all to the next station, the Israeli the Israeli pavilion when we continue this conversation. Innovations, financial model of SDG on climate action from Israel in the Israeli pavilion, which you guys going to be a guest and interacting there. We'll have some other friends from the Israeli Foreign Ministry and other offices. And lastly, in the evening, at 6 p.m. right here at the Global Innovation Hub, we would love to see you all for a COP Financial Awards, an event in partnership with UNGSII, Roland Schatz, who's going to be here, and our friends. This event will be gathering to showcase and reward the leading financial institutions according to their contribution to the SDGs. The awards will be 3 categories. This is the first time it's going to happen. We're launching it today. Insurance companies supporting the SDGs, international banks supporting the SDGs, stock exchange supporting the SDGs. And now, before we go ahead, I would like to introduce a very new friend, I would say, and a very worldly known guest from Lord Browne. Lord Browne, Lord John Browne is the outstanding figure in the field. He is best known for his role as Chief Executive Officer of British Petroleum. Since then, he's crossed the lines, so to speak. Today, he is a chairman of Beyond Net Zero, a climate growth equity venture targeting investments in companies providing solutions for climate change. Without further ado, Lord Browne, please.
Tal, thank you very much. Ladies and gentlemen, good morning. Can you hear me? I arrived here yesterday morning and I realized I took 20 minutes to get to the exit. I thought that the Hotel California was the counterpart to your example. We checked in, we couldn't check out, but here I am. I started my journey 25 years ago when I gave a speech at Stanford University which said that oil companies were part of the problem of climate change, the first person ever to say that, and actually we had to be part of the solution. As a result, the industry said that I had left the church. So I wasn't quite sure what church I was meant to be a member of and how you leave it, but I'd left the church because I'd changed the view of the industry. The good news is there are quite a few people back in the church now, rather more than there were 25 years ago. I think this is an expert audience, so I've been asked to set the scene, and I'll do it in a very shorthand way. The preoccupation and the correct preoccupation for mitigation, which is to reduce greenhouse gas emissions to effectively net zero by 2050, has been a very important ambition which must not be let go. Much technology has been developed. It's still primitive in some cases, but even with primitive technology, we could probably cover 70 to 80% of our problem today. The problem is that it's not wholly commercial. Some has to be financed by the public financing, some by private financing, and the level of incentives and valorization of the outcomes, which is the externalities, carbon, were lacking. There have been some movements in that area which are very important, not least in the United States with the Inflation Reduction Act, which has huge echoes of many, many things which have been discussed over 2 decades, about carbon pricing, about carbon capture and storage, about innovation, about enhancing new technologies, as well as providing loans and financing to a variety of different activities. It's a great thing to do, but it's nothing like enough. And we're running way behind. I'm not in the trillions business because we don't know. It's somewhere between 2 and 5 trillion a year. I think that's a wide enough range, probably. We're lacking that, and we have to do something about it. Now, as a result of the delay, my second point, I think most people are putting lower and lower probabilities on reaching 1.5 degrees as the outcome. So 1.5 degrees while still alive, and I'm all in favor of keeping what you call almost a big hairy goal alive for the future, the chances are that it will be much higher than that. And so my second point is, and that is why I believe adaptation has become a much bigger feature of what is being talked about now. So in addition to the financing of mitigation, adaptation is rising, and we need to finance that too. And we must not do one at expense of the other. So somehow we have an addition rather than a trade-off. I think the third point is that all of this has now led to people revisiting this question of what is carbon, and does it have value, and can we make that value both a regulated, standardized value that we could do something with. And so even at COP today, there are two initiatives. One is Senator Kerry's initiative, which has an accent with public finance, and then the Carbon Trust initiative, which was announced yesterday at Bloomberg, which is very much more a public-private finance initiative, which is all about, can we actually value carbon? We're going back in order to go forward. This has been a topic of discussion for a long time. Can we actually value it, and can we regulate it in a way where people actually understand what they get when they buy it? Over-the-counter markets for carbon credits don't cut it. And so we need better and better standardization so we can actually value carbon, valorize it. And the fourth thing is, if we can do that, then actually we open up the possibility of this expansion of finance. And I think the important thing here is very difficult to value things in perpetuity, very difficult to insure things in perpetuity. So actually getting things with different durations, which is what's on the agenda at the moment, duration is a big matter here, can open up possibilities of trading, possibilities of insurance, and possibilities that we can now begin to think of for this massive problem we have. As an engineer, I think it's all about getting the right framework in place to allow the systems, solutions to be applied. Because everything we do, one thing is related to the other, and we need a way of relating them. The relationship is emissions, is carbon. But it's all very well saying carbon. You then have to put something of value on it in order to make the connection really work. So I think let's see what COP27 can do. There's certainly a very interesting agenda, and I know that we'll have a much more interesting agenda here. That's all I need to say.
Thank you so much. Thank you so much. The next conversation, I would like to re-invite you, Dr. Masamba, to introduce your model. We're starting the two models top-down. The first one, green bones. Masamba, please.
Thank you. Thank you, Tal. The focus of my presentation will be on a new financial instrument that we have developed within the UN Climate Change Global Innovation Hub to help redirect finance toward green activities. You all know that green bond is one of the most popular instruments used within the financial sector to mobilize finance for green activities. But the problem with green bond is that it is facing three main challenge. The first is what I call the additionality challenge. So in the Paris Agreement, the paragraph 2.1c of the Paris Agreement call for more mobilization of finance to serve green activities. So what we are really looking for is to be able to increase the amount of finance which is available for green activities. But most of the time, what is happening, we are greening, we are labeling as green activities that anyhow would have happened. So by doing so, you do not increase the amount of finance that is available for green activities. So this is the first issue that we wanted to address, an issue of environmental integrity. The second issue is, while green bond most of the time is corporate bond or sovereign bond or municipality bond, we still have the possibility, an issuer has the possibility to ring fence some clean project and issue a green bond for this project while having very carbon intensive project that he can put under the carpet. So we wanted to address that issue also and put in place a system that allow to issue green bond holistically on a portfolio of project. And then the third point is that although it has developed very much this last year, the fraction of the capital market that is used by green bond is still very small. So there is a need to go beyond investors that are conscientious and mobilize mainstream finance to participate and buy green bond. So it was a big challenge because we wanted to have the green bond framework more, let's say, stringent in the sense that it does not allow for greenwashing, but at the same time we wanted to have it attractive to mainstream finance. So just a slide, next slide, to illustrate the issue of additionality I was talking about. So at the upper part of my diagram, what is represented here is in green the share of finance that is used for green activities. So what is happening actually, we are just increasing the amount of this project that is labeled as green. This is the red curve, but we are not increasing the total share of finance that is directed to green activity, because we are financing with green bond activities that would anyhow be financed with or without green bond. So in the lower part of the diagram, if you are saying green bond should focus on activities that otherwise wouldn't be financed, activities that are enabled by the premium paid by the bond buyer, then green bond will contribute to the 1.5 degree goal by increasing the amount of finance that is directed to green activities. Next slide. So to address this issue, we were inspired by what we have in the renewable electricity market. Those of you that are familiar with the renewable electricity market know that when you are buying green electricity and you would like to be able to claim the greenness of your consumption of electricity, alongside the electricity that you are buying, you will receive a renewable electricity certificate, which is the green attribute of the activities. So this is the same model that we have proposed here applied to green bond. So what we are saying is a green bond will be a bond, a normal bond, at which you append mitigation outcome interest, which is a forward contract. This is a commitment to deliver at maturity in the future carbon credit to the owner of this mitigation outcome interest. So it means that by doing this thing, you can make the green bond framework more environmentally integral in the sense that the carbon credit that is appended to the bond ensure that the impact is real on the ground. And then by appending the mitigation outcome interest that the holder can put in the carbon market and get additional gain out of it, you are making it attractive to the mainstream finance. So a green bond will be a normal bond at which you attach the mitigation outcome interest, which is an instrument of carbon credit indebtedness of the bond issuer to the holder of the mitigation outcome interest. Next slide, please. So these are the three key features of this new framework. This is a forward-looking approach. And this is very important because we are not focusing on how the issuer has performed in the past. We are focusing on what the issuer is planning to do, because the green bond is issued at the level of investment plan. And then the mitigation outcome unit that are generated by the project using the proceed of the green bond is what is used to pay for the mitigation outcome interest. So the mitigation outcome interest is a future contract, and you will honor your commitment to pay for this future contract using mitigation outcome unit that have been generated by the projects that are using the proceed of the green bond. And then the mitigation outcome unit are issued for the entire investment plan, so that you do not have a situation where you can actually issue green bond for some clean project and put under the carpet projects that are carbon intensive. Next slide. Yeah, so just to summarize the flow chart of green bond, these are the questions that are important to qualify a bond as green. So first, does the issuer investment plan contain activity expected to generate mitigation outcomes? The response should be yes. Do the proceed of the bond and the mitigation outcome interest provide a benefit to the issuer compared to the baseline financing condition? The response should be yes. Is the benefit contributing in enabling the generation of mitigation outcome unit? The response should be yes. And finally, are the mitigation outcome unit transfer after the climate performance gap is filled? The response is yes. So my previous speaker was saying that there was a need to standardize, and this is what actually an attempt to standardize the qualification of green for a bond. Next slide. Now here are the benefits. This will enhance transparency, objectivity, and environmental integrity, and it will optimize the use of public climate finance to enable impactful climate action. So the green bond is a bond at which you append a mitigation outcome unit. If the public sector use public finance to buy this appended mitigation outcome unit, then it provides incentive even to mainstream finance to invest in green bond. So this is a way to use in a very rational manner public finance to leverage finance from the private sector. So, and one important aspect, you can ask the question why a government would buy this type of mitigation outcome that are appended to green bond. You know that developed countries have committed to provide 100 billion per year to developing countries to support their climate action. So by buying this appended mitigation outcome, developed countries can claim that they have contributed in redirecting private finance toward green activities in developing countries. So it can help also operationalize the disclosure of exposure to climate risk and opportunity. those countries that are buying, developed countries that are buying mitigation outcome unit appended to green bond can put as criteria to buy this mitigation outcome unit that the financial entities disclose their exposure to climate risk and opportunity. Next slide. So one interesting aspect here is that carbon finance is an export reward. You have to implement your project. Your project will be assessed. You will receive mitigation outcome unit that you will sell in the market. So it's an export reward. And then for entities that are facing access to low-cost finance as barrier, they cannot benefit from the carbon market. So what we are doing here, we are transforming carbon finance from an ex-post reward to an ex-ante enabler, because this amount of finance can be mobilized upfront by selling the mitigation outcome interest like a future contract. And this presents a lot of benefit. For example, I have tried to compare with the EU taxonomy and the green bond standard. Here, aggregation is possible, taking into account the shade of green. So one question that very often is a puzzle when you are talking about green bond is, what is the shade of green? Is it a light green bond? Is it a dark green bond? We do not have criteria for that. And with this framework, it is possible to define the shade of green of a bond based on the amount of mitigation outcome units that are appended to the bond. So it can incentivize mainstream finance, because the buyer of the bond can sell the mitigation outcome interest, the forward contract, or get the mitigation outcome unit and make gain out of it. So it is forward-looking and not backward-looking. Next slide. Now, one of the, I guess, main barrier that prevented the use of this framework is that it requires a lot of tracking. You need to track the mitigation outcome unit. You need to track the mitigation outcome interest, which is a forward contract. And you need to be able to associate the bond with the mitigation outcome interest, even if they are sold separately in the secondary market. So we have worked with the Bank for International Settlement, the Hong Kong Monetary Authority, and two consortiums to produce two prototypes that are based on blockchain that will allow the tracking and the transfer of this mitigation outcome security and this mitigation outcome unit. The first is a consortia, Goldman Sachs, All Infra and Digital Asset, and then another consortia, Interopera, and Krung Thai Bank and Samwo Corporation. So I will now hand over to Goldman Sachs so that they can share with us a demo of what they have developed, the prototype that allow to operationalize the concept that I have presented. Over to you, Rosie.
Thank you so much, Masamba, and thank you as well to Lord Browne for the opening remarks and kind of positioning. I think the tracking might be a little off with my video and voice, but hopefully you can hear me regardless of that. So my name is Rosie Hampson. I work in the digital assets team here at Goldman Sachs, based in Hong Kong. And at Goldman Sachs, we actually have a dedicated digital assets team, which is inclusive of an engineering team as well. So we focus to support our clients on digitization journeys and collaborate also with the industry on kind of consortia to ensure standardization, as Masamba mentioned, but as well as engaging the broader ecosystem with investment and partnership lenses as well. So given that we are developing our capabilities to tokenize financial instruments and real-world assets to achieve that end-to-end digitization of lifecycle processes for traditional finance, we were very excited to get involved in this bond project, Project Genesis 2.0. So coupled with the firm's commitment to ESG and focused on digitization of institutional green finance, working on Project Genesis 2.0 was the perfect opportunity for us to expand our knowledge in the space, but equally leverage GS's proprietary technologies as well as expertise across the traditional and digital finance landscape. So the video that we're going to show you is a prototype tech platform that's built by Goldman Sachs, also with input from All Infra and Digital Assets, as Masamba mentioned, as part of our consortium. So we focus on the full end-to-end lifecycle of the bond, in addition to the MOI issuance, all the way through to servicing and maturity. So we felt it was important to include the green bond lifecycle within the POC, as this is obviously a core concept that is used to finance the asset that will ultimately turn into produce the carbon abatement, which are represented in the form of mitigation outcome units or MOUs. So the solution leverages blockchain technology and smart contract technology in addition to IoT devices. And importantly, we believe that the benefit of these technologies aids the fundamental ask of the project to effectively track the mitigation outcome data in a near real-time manner and provide that real transparency to the end investor, but also to the issuer and other parties that may need to be aware of this information, such as auditors as well. So we're now going to showcase the prototype via a video demo, and thank you very much for your attention to this video.
Fantastic. Thank you so much, Masamba, for this first thing. Masamba is, like some of you are booked in the same place 3 times, distinguished one. I also want to recognize as people joining us, we have Rene Carasanti here, we have Vince and Mark from the US that I saw. We have people joining us, and I want to welcome you. I want to move on to to the next speaker. Without further ado, a man I love, a man I appreciate, and a man I treasure to honor, Professor Yehuda Kahane. Give him applause. You're observing a miracle.
Dear friend, I'm sitting here today after suffering a severe stroke. In one moment, I lost my ability to speak any language, but I didn't lose my spirit. Okay. My spirit. I was paralyzed in a wheelchair, but I didn't lose my brain power or my commitment to speech, the research. Recovering from a stroke is that like bringing a new paradigm in a common model to life. Our model is based on a real story. The story of my country, Israel. We propose to, it was very useful everywhere, both to the developing countries and the developed countries. This is needed to destroy today as they are running out of time. Yes, we can.
You wanted to thank everybody. This is Yehuda's model. Please watch it.
3 years have seen the rise of a post-industrial economy, an economy marked by new underlying rules based on limitless data and information flow. This is contrasted with the previous assumptions of our economy based on limited labor, capital, and land. Our current capitalist economy does not have true competition. It also lacks a fundamental accounting for natural resources and their pricing, things such as water, minerals, societal issues, forestry, animals, and what is commonly known as the commons. The post-industrial economy has significant non-monetary elements. These non-monetary elements should be combined with current economic theories by approximation if there are no exact models. In 2015, all the nations of the world agreed on the Sustainable Development Goals, the SDGs, as the most crucial issues facing humanity that need answering by 2030. These goals include environmental and social goals such as climate action, water, zero hunger, no poverty, reducing inequality, and more. We have less than 9 years to reach these goals. The global sum of money to reach the SDGs is approximately 8 to 14 trillion annually. The global governmental budget is closer to 30 trillion. The ability of governments is constrained by the need to fulfill all the government's roles. The private market and corporations are not willing and are not equipped to do this job because global GNP stands at approximately 100 trillion. This is insufficient to close the SDGs gaps. The government's regulator should raise substantial amounts of capital through a differently fully balanced sustainability budget. This can happen by reallocating investments of the private and business sector, approximately $350 to $400 trillion worth of capital. The regulators have the power to provide incentives to support and enhance a process in which the private sector plays a significant role. It is the power to shift the entire consumption pattern towards saving natural elements and reducing waste. The business sector measures impact by economic or monetary values, but the government should account for damage and profit to the environment, to society, and businesses. The majority of externalities are non-economic values, they're non-monetary. Every economic activity has both positive and negative effects. National accountants can distinguish between activities that harm the society and environment and those actions that benefit society. The sums of capital accounted for will be enormous. This is called a sustainability budget, which can be more or less balanced. Governments will charge taxation on the negative side and pay rewards or subsidies to those on the positive side. Things that can be taxed on the negative side are things such as fossil fuels, unsustainable transportation, consumption of meat, pesticides, construction, pollution of water and oceans, paper, deforestation, clothing, construction, or even warfare. Things that could be subsidized are things that save energy, save water, waste, recycling, cradle-to-cradle technologies, renewable energy, etc. The regulator should distribute subsidies within the capital markets to pensions and insurance, as well as social security systems, those who specialize in mid- and long-term financing, mainly through long-term bonds with a national guarantee. This bond will carry a linkage with the cost of living and should be untradeable. The yield of these bonds will be substantially higher than regular bonds, especially under the current zero interest by the central banks. The ability to offer a high yield on impact investments will create a self-perpetuating cycle. Higher returns on retirement plans will increase the attractiveness of such schemes and the public propensity to save for retirement. This in turn will motivate larger long-term savings and thereby enable to finance more impact investment. The reestablishment of retirement security for millennials and future generations, providing for appropriate accretion of real value on retirement savings. In summary, we suggest a 4-step solution. Promote financing of the SDGs in order to save our existence on the planet. There's no way to solve the problem with the same tools that brought us here. Given the emergency, there's need for top-down education to bring about the incorporation of externalities, meaning non-monetary values, in conjunction with economic ideas, essentially applying environmental, social, and consciousness values alongside our economic metrics. A sustainability budget to complement a national budget and underlying national accounting measurement systems. This will enable to change the production and consumption of the world to be more optimal. We must hit several ambitious targets with a single arrow: fighting climate change, SDG financing, safeguarding pension for millennials, and enhancing job creation.
Thank you. These 5 minutes took us 2 years to produce. I want to acknowledge and recognize Or Katzman's been working with Professor Kahane's ability to. And without further ado, I want to introduce Moshe Bareket. Moshe is a very, very crucial part of our work here. Moshe, the floor is yours.
Hi, thank you very much, everybody. Happy to be here. Happy actually to be the first to introduce Yehuda, Professor Kahane, to the environmental issues. I've actually published the first paper in Israel, the first research paper about environmental liabilities, how to manage the risk, insure them, and so on, and submitted a paper to Yehuda, and he picked up greatly on that. Since then, I've done a few things. I was a professor at Duke University, chairman of the largest insurance company in Israel, and worked for the 3 regulators at senior position, the Bank Supervision Department of the Central Bank in Israel, Securities Authority, and just recently stepped down from my office as Director General of the Insurance and Savings Authority, Capital Market Insurance and Savings Authority. That leads to 3.5 years ago, when we have deliberated shared ideas that was before the unfortunate stroke that Yehuda suffered from. And we have continued with that for the benefit of us both, and we have co-authored a conceptual framework for financing climate goals and other SDGs. I would like to present the framework, and I'm not here to complain. We Israelis are very practical and pragmatic, but the current situation is almost impossible, because if we look at climate tech funds raising, for example, in the last 3 years, it was $3 billion. If you looked at fintech fundraising, it was more than 100 times that, more than $300 billion. And this is something that we need to change. Also, total funding for climate-related initiatives, the IMF just recently have published a paper estimated that at only $130 billion. This is where Yehuda and KYC slogan of billions to trillions need to come to play. So what we're saying is that really it is unrealistic to assume that government budgets, total budget government expenditures are about $3 trillion. We need about $10 trillion to meet SDG goals. Again, IMF paper estimated only climate-related goals that were prescribed by the Paris Convention. This is between $3 to $6 trillion. We cannot expect the public, the government budgets to sustain that. We need to bring along the private sector. And what we are laying down is new financial tools. This is actually a conceptual framework that is talking about the measurement, incentive schemes, and source of fundings. Next slide, please. So for those who are familiar with the pension scheme, we're talking about the three-legged stool for retirement. We have adapted that into our new paradigm. And this is what we need really. We need to change national accounting. National accounting today is based on a monetary view. We need to incorporate those impacts that are coming from the impact on environment, the impact on climate change and so on, and basically to create a sustainability budget. The next one is based on that measurement, and you know that's very basic in management. What you cannot measure, you cannot manage. And right now, what we have is either going into public financing, which again, budgets cannot sustain that, or relying on different initiatives coming from the private sector. The private sector is not the problem. The private sector is only part of the problem, and the private sector cannot solve it by itself, because the issue of externalities is grave here. The issue of externalities is huge, not in parallel with other sectors. Unless we incorporate those externalities and measure them first on a national accounting, and then based on that, provide incentive mechanisms that work, then we will bring along long-term financing, pension funds, insurance companies. Next slide, please. So first of all, essential on a macro level is to create this sustainability budget that would account for the positive and negative effects. A private sector player cannot embed it in its profit function. It's not there. Of course, it's there if you penalize him, you put taxes, carbon credit, and so on, but it's not enough. You need to have safety nets for investment. You need to have yield enhancement incentives to provide for better investment vehicles. So we are talking about a risk-reward profile that does not fit, but we are talking about a risk-reward profile of a private investor. If we add to that the returns that we can get from externalities, the national risk-reward profile, the international, the global risk-reward profile is quite different. And this is where we need to look at and analyze the total, the global risk-reward function, and then structure financing in order to provide the private sector with enough incentives to invest huge amount of money. Next slide, please. Now, my dissertation expertise are in incentive design, but I'm not talking theoretically. We have applied that for the Israeli government. We have done two things in recent years that have changed capital markets and the savings space in Israel. One is, instead of designated bonds that Yehuda was speaking about, this is one vehicle, designated bonds, government guaranteed returns. We have changed that in the last year, providing basically for safety net for private investment. So what we have done is, instead of the Israeli government providing guaranteed return bonds, they are providing now an off-balance sheet guarantee, and the money is going into private sector investments. And if they do not reach a certain level, then the government complement that. However, there is a monitor device, the regulator monitor that actively, and also we dealt with the moral hazard, for example, by this specific portfolio that the government guarantees is really following up with the other components of the portfolio that is privately managed. This way we have tackled the moral hazard issue. Another initiative is that we have provided a safety net for institutional investors to invest in tech. This brought in a matter of months that we have done with the Innovation Authority in Israel, that brought from 0 to 100 kilometers per hour in terms of investing in tech in Israel by institutional investors. It wasn't enough for them, 2 billion shekels, they could grow to $2 billion. However, with climate tech, we can go into $10 billion programs and more. This can be done on different scales in other countries as well. Next slide, please. One concern regulators have is, what about compromising retirement objective, fiduciary duty? There is no harm to fiduciary duty if you do it correctly. What you actually do is not just not compromising interest of savers. You actually improve their ecosystem of investment. You improve the resilience of the system. You reduce risk from their portfolio. The transition risk is being supported by new investment, innovation in technology, government support, and so on. This is the way we believe to finance, and I'm happy that Dr. Masamba is not here, but actually what he presented is one example that is consistent with our conceptual framework. As I said, we've done that also in Israel. Next slide, that would be the last slide. So we are building on others' research and conceptual framework. So Professor Hart, for example, this is where technology come into play. Professor Hart done something very simple but very smart. He said, if you look at human impact, that is population times affluence times technology, you move technology to the denominator, this is where you get the huge impact. And this is exactly what we are doing. We are trying to channel financing into technology. And the way to do that is, again, to tie it with infrastructure or to design it into infrastructure. This is something that we know how to do. We have the skills, and this is what we can do in order to support technology innovation into real impact in the climate, that can help the climate problem. Thank you very much.
Fantastic. Thank you so much. Round of applause. I want to recognize I'm black in the heart. No, I'm so Hunter Lovings is here. She's one of the pioneers of sustainability that I've met, and she's here. Hunter is a real hero in that regard. As other people are recognized, want to make sure you all recognize and running between meetings. Now is my privilege to invite the WAS team. Actually, would like you to come first, Ketan Patel, and join us, and then we will ask you to join us, Mattis, and we will have you guys introduce two of the ideas from our discussion, Force of Good, and let's start with you.
Yeah, it's just the two of us, okay. Thank you. Thanks very much. No, I'm just going to talk. Yeah. Thank you, Tal. Thank you for inviting us. What an important topic. I would like to approach it from three perspectives, which reflect some of the role that I have in looking at financing. So, thank you. Like ice cream. Like ice cream? Okay. So my first role is heading a foundation which looks at funding and transformation of capitalism itself. And we work with 120 financial institutions and their data to see if we can understand how they are today funding the SDGs in particular, but also climate change as part of it. The second role is as an investor, where I lead an investment fund, and we invest in the SDGs in particular, including climate transition. And the third role is as a member of the Board of Trustees of the World Academy of Art and Science, which I'm very proud to do too. There are, if I headline them, there are three important topics. Sorry.
Yeah, we've been experiencing difficulties, so hold it close and pray for help.
Thank you. So there are three topics I think to touch on in climate finance. One is the political, the second is the science, and the third is the financing piece. And the financing piece, of course, follows the other two. The Ukraine war in particular, if I start with the politics, illustrates that actually we have an overwhelming dependency on fossil fuels, which is not going to go away for a very long time. So if we look at the numbers, what it shows is the IEA predicts that fossil fuel consumption will actually increase for about a decade, then will decrease for about 2 decades, and so we will have stood still by the time we get to 2050, which means that the possibilities of achieving 1.5 C, as Lord Browne said earlier, are increasingly under question, increasingly in doubt. So that is one important part. The second thing that the Ukraine war has demonstrated from a political perspective is that the fragile states in the country are the ones that have all the money. They're the rich countries. And their populations are not ready for austerity. So they're not ready to cut back on consumption of fossil fuels. In fact, they demand energy security. And so this demand for energy security means that the fragile nation is essentially delighted to have Jeffrey Sachs and Phoebe Kanduri join us. Thank you. Hi, Phoebe. So on that political front, the Ukraine war demonstrates the fragility really of the West and really of the north of the world. It demonstrates that the populations of democracies are not ready to cut back and transfer wealth from the north to the south or the west to the poorer countries. And the Ukraine war, therefore, is an important line in the sand that tells us that by the time we get to 2050, we probably will not have cut back on our fossil fuel consumption. So I think this is an important factor when we think about financing. The second is the science, and if I touch briefly on the science part, we know that we are going to invest a huge amount in extraction, therefore, of fossil fuels. It's not going to go away if we look at the pattern the IEA has highlighted, and this political dimension that is much more acute now and well understood since the start of this year. So in that sense, the science can deliver enough technology for us to start to substitute for oil and gas, but it does not deliver enough such that the markets believe we can completely stop. There is not a substitute that is sufficiently clean, functional, available in abundance, and near free. And if it was, the markets would have shifted to it. That answer is not, it is nuclear, but it is not uranium nuclear. We now know that uranium nuclear is part of the solution in the energy mix, but it's not a short-term solution. It might be a long-term solution, but it's more likely that it's not uranium-based. So we have a science question mark too. The point at which we know we have a breakthrough in science and technology that makes oil and coal and gas irrelevant will be a point at which the markets would have fundamentally shifted away from those, and those assets will be irrelevant. But they're not. Right now, the science does not support that, so we're not at that place. The third part I want to highlight is the economics. And in the economics, if I start with the big numbers of the SDGs, we have a requirement, we believe, based on looking at the OECD numbers of 2018 and 2019 and updating those. The SDGs in total require $176 trillion to 2030. The shortfall is $135 trillion. The calculation for human security, particularly military security, is about another $60 trillion. So the 135 plus 60 is nearly $200 trillion out of a global stock of capital of $450 trillion. Everything we've heard in terms of solutions from most of the financial institutions is not sufficiently scaled. So the solutions we have today that are financial solutions are subscale. I think 200 out of 450 tells us that we would need a shift in capitalism itself to redistribute capital towards the most important goals of society. And so there are three, if I get to the financing a little bit more deeper, there are three products that make sense. One is, of course, the investment product, but I think the UN traditionally has overemphasized the investment product. The investment product needs a return that allows it to pay pensions and insurance payments and savings and mortgages and so on. It is just not made available for this kind of investment. So there is insufficient investment product that is free investment product that you could actually reapply. Now you could tax it and redistribute it, but then you would have to make a split between the funding of governments from the capitalist model. So I think we have another fundamental issue, but the investment model is one part of the solution. The second, and in dialogue with the chairman of one of the world's biggest reinsurers, I learned something very interesting, which is the reinsurance product, particularly insurance in terms of smart insurance, is now seeing resilience as the thing to fund. It's not funding what happens when things go wrong. It's saying, what can we do to make sure that it won't go wrong? And if it does go wrong, it has to go very dramatically wrong for us to have to make payments. And so the financing of resilience is probably the job of the global insurance industry. And I think that's a very important product. The third, of course, are derivatives, but I think derivatives are a transition product. And it's a little bit like statins when you have an issue in your body. You take them because you don't want to cut back on the carbs and the saturated fats that you eat. And I think that's our problem. We actually don't want to cut back on consumption. We want to be a consumer-led capitalist society. And as such, derivatives allow us to keep feeding that for a very long time unless we wean ourselves off. So they're a transition finance model, but they're not the answer. So we're left saying finance would need to fund resilience, mitigation and adaptation, because 1.5C is seriously in question, if not perhaps achievable. And the third part is we would have to invest in much larger magnitudes than we've ever done to make a transition away from a carbon-built civilization to something which is different. And we've not made that kind of investment. We're still feeding the habit. And so that's the headlines I would leave you with.
Fantastic. Thank you very much, Ketan. I just want to recognize the panel has just been filled with Professor Jeffrey Sachs. Phoebe, welcome back. The relationship between the UNFC here, the Climate Arrangement, and SDSN, and the World Academy of Art and Science allowed me to meet bright people. And we just had Mike Hayes joins us. Mike is the global head of renewable energy at KPMG, and he will join us to the panel. But before we go ahead, let's hear some words about the Tao of Finance from you, Stefan. Yeah. Oh, whatever. Okay, and then we go to the panel.
I would like to leave most of the floor for Jeffrey and Phoebe to make sure. I mean, in 1972, the Club of Rome published Limits to Growth, right? It's a 50-year anniversary. And we did not consider finance as part of the equation at that time. Now we have a full finance day at COP, and realizing that the real game changer is going to be the monetary and financial sector. It's not technology alone. It's not the mindset alone. It's not lifestyle changes alone. It's probably the monetary system itself, right? If you look at the UN SDGs, we've been learning today is a funding gap of 4 to 5 trillion, roughly, every year. And the question could be, where does that money come from? We can tap into private money, but then we end up privatizing UN SDGs. We end up privatizing our future, right? 85% of wealth is already privatized. We can tap into public money by taxing our value chain and using that money to fund UN SDGs. But if you take all these figures together, the private investment, the tax money, even philanthropy, the volume of money we can generate is probably too slow and too low to meet the goals within the next 10, 15 years. So one of the proposals we made at WAS, at the World Academy, is we need regulators and central bankers being part of the game. So in one word, we need something like a green QE. You know, from a medical perspective, we are in a situation like a secondary prevention state. We set a damage to the planet, to the people, and we know that there's additional costs ahead because of that damage. And the question is, how can we keep that cost of the damage as low as possible, right? And one way to do it is we have central banks being more engaged in providing liquidity, conditioned liquidity, to fund UN SDGs, providing additional swaps, securities, state guarantees that are able to allow us to swap from fossil to green. In our initiative of the World Academy, we've been trying to explain several dozens of these instruments, and I'm happy to discuss them with you in details beyond that format, but I would like to take the opportunity to rather have Phoebe and Jeffrey talking on that topic. Thank you very much.
It's a pleasure to be back to our home, basically. because the Innovation Hub is our home for this COP. We were at the Met Pavilion talking about sustainable land use systems. That's why we are a bit late in coming in, which are a big part of this transition. Energy systems and land use systems need to transform in order to allow us to be climate resilient and climate neutral, and at the same time conceive this transition to climate neutrality within the general framework of sustainable growth in countries across nations according to the SDGs. So when we are talking about sustainable finance, let's keep it sustainable finance. Don't name it green finance. It's not just about saving the environment. It's about saving the people and their economy and their society and their culture within this planet. So sustainable finance, where is the finance going to come from? How are we going to create that financial space, fiscal, monetary, coming from private funds? How are we going to create that space in order to finance the SDGs in a systemic, holistic, and integrated way, which is compatible with what the scientific models are showing? Science says we need to have system solutions. We need to have in our mind the macro, the meso, and the micro scale. And we need to engage all the stakeholders and identify the optimal location between the public-private partnerships that can finance the goals. So before saying something about my group's work, I will turn it to you, Jeff, and ask you, where are we going to find the money for the SDGs?
I don't think that there's much problem of finding the money, nor is there really a deep problem of the technical side of the what to do. The problem mostly is about power and the decision to do things. So when you think about a world that produces, even on the conventional estimates, which are incomplete, $100 trillion of output per year, an incremental trillion or 2 trillion or even $4 trillion is not an unmanageable sum. It's 1 or 2 or 4% of world output. By the way, the cost of the energy transition is much less than an incremental 4 trillion, because what is needed may be 4 or 5 or 6 trillion of investment per year, but we're already making several $trillion investment per year, but usually in fossil fuels rather than in the clean energy. So the net cost might be an incremental trillion, maybe $2 trillion a year, 1 or 2% of GDP. It's really quite manageable. And if one talked about the Sustainable Development Goals, add in another $2 or $3 trillion a year for achieving transformations in health and education and other areas. The problem isn't the amounts. Always divide by the size of the economy, and then you can see that we're talking about quite modest levels. The problem is the decision to do these things. Why do we have to decide to do these things? Why won't markets, quote unquote, do them
on their own, the answer is twofold. One is that there are many important things that markets don't price. One of them is climate safety. So that's a political decision itself. It's not right to say, well, the markets would have already solved it. The atmosphere is a free dumping ground right now. And it is a free dumping ground because politically, the United States, for example, doesn't want to make it a costly dumping ground because the people that dump into the atmosphere buy the politicians, just like our $16 billion election that we had today. It costs money. Who pays for that? Exxon and others. Okay, very simple. So you can't expect the markets to do it. You have to have political decisions to do this. And there are several kinds of political decisions that the West, so-called, doesn't want to make. And we heard about them already. One is that if you really have an open system, what happens? Well, you get countries like China developing very fast. And the United States decided several years ago it doesn't want China to be successful. Pretty obnoxious, by the way. China says they'll be successful whether the United States wants it or not. But they don't want it to be successful, so now the United States is trying to do everything possible to stop China's continued success. Now we ban exports of technology, we prohibit investments, we do all sorts of non-market things to block markets because we don't want China to be successful. In general, the West does not want other parts of the world to be that successful. They'd like other parts of the world to be quiet. They can't just be quiet because other parts of the world want to be successful. And because the damage from the environment is actually really impacting the life on this planet right now. And the United States has a quarter of that historical responsibility. So the problem is we don't have the power structures to actually redress the ways that our international system works. The issues we're talking about here were almost not on the agenda of any one of the 435 congressional races today. Nobody talks about this because it's not part of the power game. So that's what we're up against. Actually, the main thing that the world needs right now is to tell the West, Europe kind of gets it, the United States doesn't get it at all, that the old game is over. Because the West has ruled for 200 years, 250 I would put it, ever since James Watt made his steam engine. Really a clever move which created the British Empire. But ever since then, the West has been content as long as it's in charge. But you know, the West is 330 million people in the United States, 450 million in Europe, that's 780 million. Tomorrow we reach 8 billion on the planet. So we're talking about a tenth of the world population saying, we'll decide. And what we're doing here is saying, no, there's another 90% of the world that wants in on finance, on a safe environment, on technology, and so on. That's what is really at stake here, is rules of the game that reflect the whole planet versus a few powerful countries. More than that is technical. How do you make capital go from one place to another? You tax that free dumping ground in the environment, for example. You make a plan for public investment. All sorts of things. You make better technologies through research and development, as has been done in renewable energy. You expand development finance from the measly $100 billion a year that it is right now to $1 trillion a year through the international institutions we created. Then you start getting kids in school in poor countries. You start getting a basic infrastructure. You start getting more than 20% of people in rural areas in Africa with electricity or with digital access. It's not so hard once you decide you want to do it. So that's really what we're trying to do in these years, is end the Western-dominated world and have a world that is cooperative together, that is using our world resources, our know-how, our technology to make a decent world. And we're getting closer because the arithmetic is in the right way, the knowledge is right, and it's just a little bit more effort, I think. Thank you.
Thank you, Jeff. Thank you so much. Okay, here's another question. Does the cost efficiency of the solutions, the increased cost efficiency that derives from the unprecedented, historically unprecedented technological advancement, does it create a power, an acceleration power that can really help in changing this power game and allowing the stakeholders a bottom-up approach to mobilize the change, the transformation using this technology, but also mobilize the voters to identify those leaders that will embrace the change beyond power games? How does the insurance industry respond to that?
Sorry, oops, sorry about that. Good morning or good afternoon, everybody. So that's a powerful question, and I'm going to dissect it in a number of different ways. And if it's okay, I want to pick up on some of the comments that have been made as well and maybe give a private sector perspective on what I've heard. So first of all, you spoke about technology and innovation. So there's been a lot of discussion here at COP and today about developing countries and the development challenge we have with financing. The other big financing challenge we have... Is that better? Good. So the other really big financing challenge we have is innovation. What is happening across the world is innovators have responded to the challenge. I saw one of the speakers put up a quote from Winston Churchill earlier, and I'm very inspired by how Winston Churchill challenged another big crisis. And one of the things, if you look back to our history, at times of war, we innovated. We innovated for terrible purposes. Now we need to innovate for the most important purpose. The challenge we have globally is we are not supporting these innovators. Whether it's the insurance industry, whether it's the broader financial services industry, we're not getting capital to the innovators. And for me, that is, together with the failure to get capital for adaptation, for loss and damage, for renewable projects in the developing world, the failure to fund and support innovation is a critical issue. The insurance industry, I'm not from the insurance industry, but I will comment, the insurance industry has a powerful role to play. And one of my single biggest concerns is that the ability of the insurance industry to help in terms of what we're trying to achieve, all the objectives we've discussed this morning, is very poorly misunderstood. I've met a number of global insurance companies here at COP, and they are frustrated. They actually have some of the solutions, but the lack of awareness of how insurance looks at risk. And I want to come back, if I could, to this point of risk. I've loved the contributions, but I have not heard enough discussion about risk. If we are really going to mobilize the capital, Jeffrey said there's enough capital there. Listen to that. That is absolutely correct. What is missing is mobilizing capital in the right direction. And the issue is risk. I look to governments not for money. I look to governments for definitive certainty around policy. If governments can deliver on policy and can help us mitigate risk, and I love the concept that Masamba put up earlier about the mitigation outcome units, that's where governments can play a role. We keep looking to government saying, please solve the problem. That is never, ever, ever going to work. And I absolutely agree with what Jeffrey said. We need to think about this globally rather than through a developed country lens. But once you start to think about risk, that's where the insurance companies come in, but it's also where governments come in. That's where we need help. The private sector will respond. They'll respond to risk mitigation measures. They'll respond when it makes it easier. They want these investment opportunities. They want to invest, but they're worried about a couple of things. They're worried about political uncertainty. They're worried about foreign currency. They're worried about infrastructure and climate and energy policy in these jurisdictions. So these are the type of issues that we need to focus on, and that's the way we're going to mobilize private investment. So do I have 1 minute to make one more comment?
Yes.
So just one more comment. We have discussed at length this morning the role of governments and the role of business. I did hear one of the speakers talk about pensions. We need to mobilize global citizens to invest in this agenda. This is not your problem or your problem, it's my problem. Every one of us have to care about this. And the more we start thinking about how global citizens can financially contribute to this, it doesn't have to be in large amounts of money, but if you can mobilize the hundreds and hundreds of millions of people around the world, I think that will do two things. First of all, it will raise money. And secondly, we spoke about voters, and I think you raised it in your question. It will mobilize people to say to governments, we're doing it, why can't you follow?
Thank you so much. Thank you so much. This is informative and very interesting. One thing that is crucial is the ability to measure. Measure the risks, measure the externalities that are creating and are correlated with this risk. And after you have this quantification, you can actually create the portfolios that can support this investment. So quantification, measurement, and increasing awareness at large scale that can really create the critical mass of awareness around the citizens, around the financial institutions, around the businesses, that it is possible to gain socially, financially, and environmentally, and with regards to their health from this transformation and this transition. And indeed, the insurance companies and the pension funds are crucial. But even more crucial, the explicit understanding of the developed world that without the enabling of the global south, the problem cannot be solved. So multilateral institutions, multilateral banks have a big role to play in this financing. There is a comment from the front round. Thank you very much. Please introduce yourself.
Sure. I'm René Carcenti. I'm in charge of the International Capital Market Association. And we set up the, can you hear? And we set up the standards for the green bonds, the green bond principles. So far, 98% of all the green bond issued in the world are under market standard, which we have set up. I'd like to follow up on Professor Sachs' comment. I share his view that the trillions, 1 to 3 to 4 trillions, could be raised if we have the proper model. Just to give you a figure, green bonds last year and sustainable bonds, the volume raised was 1 trillion plus. So you see, these are the capital market, fixed income, just that. What is needed? What is needed is, of course, the political will. I will not comment on that. But what is needed is a partnership with the public sector. And Moshe is right when it says that some form of incentives or risk sharing with authorities is needed. For example, sharing the first loss or guaranteeing the first loss of a project. What is needed is innovation. innovative products, and in our capital markets, we are innovating. We have sustainable linked bonds. We are working on securitized bonds. We are working on loans and so on. This is happening. This is happening, and we are broadening. What is needed also is proper measures and reporting. And of course, this is required by the investors. We are fortunate that investors and the pension funds are now the new generation, the younger generation, are savings and are coming more and more. They are inheriting from their parents, and they are motivated to invest in sustainable projects. They are bringing us back to the roots of finance, where finance is channeling funds towards productive projects. When finance help rebuild the nation, the world, when finance save lives. This is where we are. The third point I wanted to make is we need proper reporting and we need proper standardization. We have the international ESSB now, which is helping. Two more points. One is a point which is of importance on technology, and it has been made. Technology can help also in finance, in helping and structuring finance. I give you one example. Carbon credits. Carbon credits are fragmented markets. We need a network a global, and we need as well a common technology. Last but not least, biodiversity and nature risk finance is important. And if I may, just as a teaser, I would like to invite you at 5 p.m. at a roundtable which we organize at the UK Pavilion, where we will release and disclose the work of a working group under the UK Treasury on climate resilient debt clauses. When a country is exposed to climate risk, like Barbados with hurricanes, pre-agreed clauses which will help the country suspend or postpone payments in that. So there will be some announcement later in the day. Thank you for giving me this opportunity.
Thank you so much for your intervention. As a teaser, I invite you to stay a bit after this session because we are showcasing our work on monetizing ecosystem services and natural capital and integrating in sustainable finance, and then showing a three-step methodology that this can be integrated not just in government accounts, but also in the transformation of the value chain of the products of the businesses. And of all you said, I am in full agreement, and now I understood who you are. It's crazy these days, you know people and you don't really know them physically. What is, for me, the most important part is transparency and quantification. If you have that, it's a huge power for mobilizing policy, frameworks that are relevant and can accelerate investment and movement of capital, and also increasing awareness of the general public. You need quantification and you need to be exact and away from greenwashing. This sincerity in what you do is what can change the power game. Ketan, yes, Jeff, please. And then I'm coming to Ketan and
I wanted to, thank you very much. I wanted to ask a question about green bonds and about financing like this. I have a very simple model in my head. I start with a basic problem. If you look at the 82 countries that are either low income or lower middle income countries, 79 are sub-investment grade countries. They don't have an investment grade. If they go out to borrow on the bond market, they pay 10% interest, 12% interest. They get a maturity of 3 years or 5 years. So my basic model is very simple, that the World Bank or the African Development Bank or some other regional bank should borrow massively as green bonds from private investors and then use their AA plus or AAA rating to on-lend at 4% interest to their members, to their clients. That's my model. I'd be perfectly happy for a country in that category to float a green bond as long as it can float it at 4% interest. How can it do that? Yes. So, you know, why it is like a first loss guarantee, but the first loss guarantee is paid in capital to these multilateral banks. We have that. Why not pay in more capital and float more green bonds through the banks rather than the individual countries? Or if there's an alternative system, how to manage it so that countries float their own bonds but end up paying basically 4%. What I don't want, because I've been in the business for 41 years now advising countries in crisis, I don't want them to borrow at 10%. That's what so if you can get me a green bond at 4%, or let's just put it this way, at 200 basis points or less above the German 30-year rate or above the US 30-year rate, I'm all in. If you can do it, let's work together. I have lots of countries that need to borrow a lot more money.
Thank you very much. If I may, Jeff, this is a very pertinent question, and I'm glad you are asking it because I'm a member of the expert panel set up by the G20 for boosting the MDB financing. And if you read our report, which we have provided to the G20 in donation of presidency, you will see exactly some recommendations. One is making use and taking a little bit more risk while I'm talking of the MDBs, multilateral development banks, while keeping their AAA rating. But there is room for using innovative instruments like guarantees, like securitizations and other products, which will help in doing so. So the answer to your question is not one or the other. It's a bond issuance by countries with some form of guarantees and boosting the on-lending of or other financing of the MDBs through innovative techniques like securitizing portfolios, like risk transfers, which is what we recommend in our report, the MDB boosting, MDB capital adequacy framework report. Thank you.
Thank you very much. Let me close this session with a quick question to Stefan and Ketan. There are projects out there. We've been told that they need to be securitized if they are in developing countries. We have ways to do that. What is the main challenge for this money to be invested while providing for securitization? And you coming from the financial industry, let me have your quick comment on that.
So look, a quick comment would be it's easier to fund going to Mars than it is to fund a developing country's requirement for climate change. That's how strange capital has become in terms of its allocation. So, and if you take all the money of all the development banks, all the DFIs, and you add it together, it's equivalent to a small division of a major bank. So they can't take enough first loss. They're just not scaled. And so there is a need to rethink how that money gets allocated. And it isn't happening naturally from the markets. we're funding about less than $1 trillion a year when we need to fund 4 trillion, and from 2030 we need to fund 6 to 7 trillion. But the numbers are so big, why isn't it happening? It's as if the return isn't good enough for the risk. And we spoke earlier a little bit about risk, but the risk and the return are not matching for investors. And part of the answer is individuals. Individuals own 2/3 of the world's money. As individuals, if we decide to allocate that money differently, to reprioritize it, it will be reprioritized. I think we have not discovered the power of the individual in capitalism the way we've discovered in politics. And that will happen pretty soon. I mean, we're not very far away from that.
Let me take the showcase Jeffrey mentioned. If the green bond delta for Ghana is 5 times higher than the same in Germany, who is funding these 5 times delta, right? What would happen if this is done by regulators and central banks, providing a green QE, upfront loading the African developing band, providing exactly that delta so Ghana can build up green bonds and green windmills?
I'm not in favor. And the reason is, basically, we have to keep the central banks doing central banking, and we have to let finance do finance. There's a reason for that. The Fed forgot that in the last 3 years, and it created a lot of liquidity and a lot of inflation. And we were told by modern monetary theorists who were talking about ancient theory that I learned 50 years ago that was not very good then, don't worry about it. But, you know, if you print a lot of money, you get inflation. And we want to keep the monetary side away from the finance side. Let central banks do central banking. And let savings be channeled properly to the priority needs and not mix up the monetary accounts where the central banks can come in. The central banks, if you are a borrower from a major central bank, you pay several percentage points lower interest rates, period, because you're guaranteed liquidity. If you're one of 150 countries that is not the US dollar, the Fed, or the European Central Bank, or a couple of other central banks, you automatically pay a significant risk premium. The 2 of the 3 Nobel laureates in economics this year, Diamond and Dybvig, explained that in a paper in 1983. It was a very nice paper. They said markets are inherently unstable. They can develop their own illiquidity out of a panic. And that's basically what that paper said. Like everything in economics, that was already known for 200 years. Anyway, they wrote it down nicely. It got a Nobel Prize for it. But the problem is, if you don't have liquidity, you can't float these bonds very well. And so where the central banks, the Fed protects favorite clients like Korea by giving them swap lines. If the IMF were really at the level that it should be in scale, it would give swap lines basically to build liquidity in sovereign bond markets. But that's not, that was the debate between Keynes and Harry Dexter White back in 1944, and the US won and the world lost in that debate. So anyway, it's a long story, but I think we should keep the central banks basically out of climate finance and bring in normal politicians, not out to wreck the world.
Thank you, Jeff. It must ring a bell, right? It's a big topic, and we had discussions with Stefan on that, and my opinion is very close to the one of Jeff. Yeah, please.
Thank you very much. I'm sorry, I may be the only one that is not an economist here, and I want to take you to some other stories. It's not a question, it's a story. We are here because we want to stop emissions, right? So let's think about what is needed to cut emissions. We need just to stop burning fuel. This is the question, this is the problem. I'm a chemist and I'm a venture capitalist, and I think that your role is the only and most important role in this transition, because it's not about technology. How do I know? Because the Chinese invested 15 years in becoming the most important and the only solar producer in the world, and all of us are making a lot of money in all the countries buying panels and producing solar electricity. That's the question. So I want to try to tell you how I see in a very simplistic way, because I'm a chemist. One is that if we have to cap the emissions, we have to have a transition. The good news is that solar energy today, because of the Chinese, is cheaper than anything else. Not only healthier, not only is going to help us, it's cheaper, it's a business. I'm hearing about trillions and trillions of dollars of cost. I'm telling you the following, and please, I don't want to take the time of all the people. When you invest in a factory to produce from zero, because the dependence is not today. The problem is not today. The dependence is when you build the tube from Russia to Germany. That was the day that you decided to be dependent. It's not something that happened today. And we are depending right now on China. We have to spread the production of solar panels to all over the world in at least 10 hubs. But the story is simple, and I'm challenging you because I feel very small compared to your roles. One thing I can tell you, if you invest $400 million, no grants, no loans, $400 million in a fab of 1 gigawatt panels, this fab, no matter if it's in the Middle East or the United States, will produce 1 gigawatt of panels after 1 year. This gigawatt will produce an asset that will give you money for 25 and now 30 and 34 years. This is what they do. We are innovators in the solar energy. The asset has a very, very important middle name, net present value. And that's the whole story. The net present value of this asset is much more, I don't want to tell you the numbers, but it's much more than the $400 million. So we are talking about self-fundable solution. The solution is here, the technology is here, there is nothing to invent, there is a lot to improve. Nothing to invent, the solution is here. The only thing that we have to do is to use this as a huge opportunity to make the biggest industry ever in the history of humankind, and not seize at cost of trillions and trillions and trillions without talking about the assets that we are creating that will power communities for water, for food, for agriculture, for businesses in the south and in the north. And I agree with all of you, but try to think in other ways as opportunity, not a cost. Thank you.
Thank you very much. I have to close this panel because we are beyond our time. Nobody is disputing the cost efficiency of solar. It's not the only solution around. We need the optimal mixture of solutions for securitization as well. There are many technologies that are much more cost efficient than fossil fuels, but we need the infrastructure, we need the capacity, we need the skills, and we need the financing, which is partly self-financed, but there is more to it because you need to implement it in countries that have different infrastructures and different skills. So yes, the solutions, the technological solutions are there. Even more are being created, looking at hydrogen and so on. So let me say, science is crucial, innovation is crucial, and you are the ones that are mobilizing the transformation. We need to get our act together in order to accelerate the funding and implementation of the transformation. Thank you very much.
Thank you for this outstanding, guys. Thank you very much. This is the first conversation